Are you self-employed? Don't retire until you've watched this video on the 4 crucial aspects of retirement planning. Hi, my name is Tommy Cloud. I am president of Third Act Retirement Planning, a company that I started back in 2000. I am also a certified financial planner and qualified Kingdom advisor. Today we're going to be looking at the ways someone who's self-employed needs to prepare themselves as they get closer and closer to a time when they're no longer able to work as hard. Okay, so let's lay the ground rules first. We're really just going to be talking about things from a financial perspective, which, of course, as we all know, those are not the most important things. We're not going to talk about time with friends and family. We're not going to talk about vacations. We're not going to talk about your health, which, of course, is extremely important. We're not going to talk about your relationship with God, which is the most important thing to people that are believers in Christ. So we're not going to cover any of that. We're mainly going to focus on the 4 important aspects of the money piece of it. And we're also not going to cover, retirement. Of course, we know as Christians, we don't believe in retirement necessarily. We believe in we can't work anymore. We've gotten too old. We can't do what we used to do. So we retire from full-time work and we go into full-time serving others as our health allows. So we obviously know that. There's nowhere is retirement mentioned in the Bible, which is kind of odd since the name of my business is Third Act Retirement Planning. So right now we're going to start out number 1, and we're going to talk about plans. Let's talk about the best retirement plans for self-employed business owners. Just like the Beatles saying, will you still need me? Will you still feed me when I'm 64?
Will you still need me? Will you still feed me when I'm 64?
Well, with the right retirement plan, you'll be feeding yourself just fine. So let's first of all start with the solo 401k. This plan is a hit for self-employed individuals without employees. In 2024, you can contribute up to $69,000, combining both employee and employer contributions. This plan also allows for Roth contributions, providing tax-free growth and withdrawals in retirement. Plus, the solo 401k offers the option to borrow from plan assets, a handy feature for managing cash flow. But remember, with great power comes great responsibility, and these plans come with more complex setups compared to SEP IRAs, which is going to be our next one. Number 2 type of retirement plan under the number 1 aspect, which is retirement plans, is going to be a SEP IRA. For the self-employed, it's as straightforward as Johnny Cash's lyrics and allows contributions up to 25% of net earnings. So that's what you're paying yourself, with a maximum also of $69,000 in 2024. They're easy to set up and maintain, making them a practical choice for many self-employed individuals. However, they don't allow for loans or Roth contributions, which can be a limitation for most of our clients. We try to get into Roth as much as possible, especially if they're paying Social Security and Medicare taxes. We know Social Security is going to be coming. We have no idea what the tax rates are going to be. They're pretty low historically now, and we really want to make sure that we get as much as we can into those Roths, because we know when they retire and we start trying to plan for taxation in the next bracket up, those Roth contributions and Roth withdrawals later, they don't impact taxes at all. They're tax-free. And by the way, so are HS withdrawals if they're for medical purposes. Next one is a simple IRA under plans. So you can open up a simple IRA. They are designed for small business owners, including the self-employed, who may have a few employees. It allows for employee contributions up to $16,000 in 2024 with an additional catch-up contribution for those aged 50 and older. Employers are required to make contributions which can be either matching or non-elective. This plan is easier to administer than a solo 401k, but has lower contribution limits. We're also going to, thirdly, talk about the defined benefit plan. For those of you who are consistently high earners, a defined benefit plan can be your ticket. These plans allow for even larger tax-deferred contributions than a solo 401k or SEP IRA. They're more complex and costly to administer, but can be highly beneficial for maximizing retirement savings. And we're going to talk more about those when we get finished with this list. But You can also have other plans combined with a defined benefit plan. So if you're doing really well and have a lot of discretionary income coming in, those are great plans to stuff as much as you can into a retirement plan for yourself and your family. Finally, of course, you have the good old traditional and Roth IRAs. They're like the reliable oldies on your radio, especially for those with lower self-employment income. They offer tax advantages with Roth IRAs, providing tax-free growth withdrawals. In 2024, you're able to contribute up to $7,000, and then you get an additional catch-up contribution. So let's review this. Choosing the right retirement plan is going to depend on your individual circumstances, such as your income level, whether you have employees, and your retirement savings goals. Solo 401ks are often the best choice for solo proprietors without employees due to their high contribution limits and flexibility. SEP IRAs are ideal for those who want simplicity and have no plans to hire employees. Simple IRAs are suitable for those expecting to grow their workforce. Remember, as Proverbs 21:5 says, the plans of the diligent surely lead to abundance. All right, let's pause for a moment for station identification. This is Sudden Wealth Stewardship Channel, and I just wanted you to know that below you can set up a time to meet with me briefly, and we can talk about your situation and what type of retirement plans may be best for you. Also, there's ability for you to click on a link below and set up a call. We'll be happy to review any portfolios and kind of look at your holdings and give you an analysis of that at no charge. These are for portfolios for $500,000 and higher. Additionally, we'll also put together a one-page plan for you at no charge, and we'll have an example of that as well below, so you can look at the one-page plan and see if that would be something that would be beneficial to you. In the meantime, if you are enjoying these videos, if you're getting anything from them, I encourage you to like and subscribe. What do you have set up as your retirement plan if you're a high-earning, self-employed individual? Okay, let's jump into the defined benefit plan. It's also known as a pension plan, and it's a type of retirement plan where the employer, which in this case happens to be the employee, guarantees a specified retirement benefit amount to the employee based on a set formula. These became very unpopular. All the big corporations moved to 401ks, and now actually there are some large corporations that are going back to the defined benefit plan because it showed that their employees worked harder, had a longer tenure there, and there were many benefits from offering that to their employees. So going back to the defined benefit plan, it has a formula that typically considers factors like the employee's salary, their age, and years of service. For self-employed individuals or small business owners, the defined benefit plans can be a powerful tool for retirement savings. They can potentially allow for much larger contributions than other retirement plans, like even solo 401ks or SEP IRAs, which we already discussed were $69,000 per year. But I'm talking like $275,000 is the max for a defined benefit plan. And we're going to go over an example of this in a second. And mainly, the IRS calculates the annual contribution limit to ensure the plan has enough funds to provide the predetermined retirement benefit. The older you are and the closer you are to retirement, the higher the contribution limit tends to be. This can be particularly advantageous for older business owners who may have started saving for retirement later in life. So let's consider a hypothetical case study. John, he's a 50-year-old self-employed consultant. He's been doing well in his business and wants to save more for his retirement because he really hasn't saved a ton up until age 50. He's currently contributing the maximum to his SEP IRA, which is 25% of his compensation, or $58,000, whichever's less. John learns about the defined benefit plans and decides to set up one for his business. After working with a financial advisor, he determines he can safely promise himself a yearly pension of $220,000 at retirement. Using the IRS's actuarial tables and formulas, his advisor calculates that John can contribute approximately $200,000 to his defined benefit plan each year, significantly more than he could to his SEP IRA. So by using a defined benefit plan, John is able to accelerate his retirement savings and take advantage of significant tax deductions as contributions to the plan are generally tax deductible. So let's just calculate the tax savings John could potentially achieve by contributing to a defined benefit plan instead of a SEP IRA. Assuming John's annual income is $400,000, his maximum contribution to a SEP IRA is $58,000, and his contribution to the defined benefit plan is $200,000. If we assume a tax rate of 37%, we can calculate the tax savings for both SEP IRA and the defined benefit plan. So for the SEP IRA, the tax savings would be about $21,460. For the defined benefit plan, the tax savings would be $74,000. The difference in tax savings, or the additional tax savings, John could, by contributing to a defined benefit plan, is $52,540 for the year. Therefore, by contributing to a defined benefit plan instead of a SEP IRA, John could potentially save an additional $52,540 in taxes each year. This is a significant amount and illustrates the potential tax savings of defined benefit plans for self-employed individuals or small business owners. And as a reminder, in Proverbs 21:20, we read, "The wise store up choice food and olive oil." So that is the first one, is plans. I'm going to put savings with that as well. So it could be that you have in this particular basket, it could be rental properties, precious metals that you own, or even taxable brokerage accounts. We're also going to lump that with the retirement plans and savings. And then number two is going to be your house. And many people say, well, I'm not going to use my house during retirement. Well, you may not want to. You certainly may not want to use your house for retirement. You may want to put it in a trust. Your house may have grown so much, you may be able to sell it, and you may be able to move to a smaller house. Or you could even do a reverse mortgage if you really wanted to beef up your comfort level in retirement when you've got other assets that you want to leave to beneficiaries that are, in your family or friends or church or whatever it is you want to do there. So we do want to have house there, and a lot of people don't. A lot of people don't use their house at all for retirement. They just simply leave it to the next generation or to their church. Additionally, we also are going to, number three, we're going to have Social Security. And again, this is a controversial topic because many of us believe that it's not going to be around. But I don't get into that. If you are going to do Social Security, you do have to pay yourself something as a self-employed person. And we're going to get into that in our final one for number 4 as well. But for right now, just know that you have to pay yourself some sort of salary. You can pay yourself the rest in distributions, but your CPA will be able to help you determine what's probably the lowest amount you can pay yourself without triggering an audit or getting fined or doing what the IRS would call taking advantage of the rules there and go back and they want you to backdate this. So, or if you do believe in Social Security, you can go ahead and max yourself out on the wage base there and just pay yourself 100% in W-2 wages. It'll max out your Social Security. That's going to be the third one that is going to provide you with income during retirement. And then finally, the fourth thing is your business. And many of you will not be able to sell your business. Only 20% of business owners can, and it's because they're not prepared. They don't take the time to prepare. They feel like they're slammed. They feel like they don't have any time. They don't know what to do. You need to be able to understand the last 3 years that you're in business, you need to pay as much taxes as you can, because that's going to be what's used to value your business when you go to sell it, are your tax returns. The tax returns are the holy grail. So as much as you can pay yourself out, particularly in the W-2 wages, just the last 3 years, it'll help you in valuing your business. How much can you sell your business for? I don't know. I couldn't tell you that. It's probably going to be somewhere for most people between 1 times what you pay yourself and 4 times what you pay yourself at the most. So if you pay yourself $200,000 a year, you could probably sell your business anywhere from $200,000 to $800,000. This is a very, very vital piece for many business owners, especially the high earning ones. And so don't neglect this one. Take the time, your last 3, to pay the taxes. Or as the old commercial used to say, take the time to let one beer stand clear. I don't know if you remember that commercial. But anyway, these are the 4 pillars from a financial perspective of what a self-employed person can do to prepare themselves for a time when their bodies will no longer allow themselves to work. And those are, again, your savings or retirement plans. Number 2, your home, that may not apply, Social Security to whatever degree that you believe it is or is not going to exist, and then number 4 is going to be selling. And my name is Tommy Cloud, president of Third Act Retirement Planning. We look forward to seeing you again.